A pair of worn work boots, a mended flannel jacket held together by safety pins, and a wooden broom leaning against a Vermont gas station wall hardly look like the foundation of an $8 empire. Yet when Ronald Read passed away at age 90, adjusted compensation across his entire working life. Pause. How does a manual laborer quietly accumulate a net worth greater than that of most corporate chief executives, surgeons, and commercial real estate brokers? The answer reveals a structural flaw in how contemporary financial media conditions you and me to view money. We are conditioned to believe that building significant wealth requires an elite six-frequency trading algorithms. Wall Street institutions spend billions annually promoting the narrative that financial independence requires relentless transaction activity, continuous monitoring, and paid advisory fees. Breath. The mechanical truth is far quieter, far more predictable, and vastly more powerful for everyday investors. Wealth is not a function of your income velocity. Your professional wealth is the mathematical outcome of an unyielding capital preservation system executed without interruption across long time horizons. The core investment principle that you and I must internalize is absolute. Your structural edge in the market does not come from timing price action, but from refusing to interrupt long-focused paradigms repeatedly fail typical households. Data collected by the Federal Reserve shows that nearly 60% of households earning over $100,000 annually report living paycheck to paycheck. In major economic hubs, high-term capital gains tax liabilities and succumb to behavioral biases that reset their wealth curve back to baseline. By contrast, systematic capital allocation into high-stage ventures, and complex leverage instruments that lacked underlying cash flows. Instead, he directed his humble monthly savings toward boring, defensive, real Palmolive. Pause. He never attempted to time equity valuations, guess federal interest rate adjustments, or liquidate holdings during broad market panics. Whenever quarterly cash dividends entered his account, he immediately redirected those proceeds back into purchasing additional fractional shares. This mechanism transformed his modest monthly contributions into a perpetual self-deferred envelope until his death. To put this structural engine into clear numerical terms, let us break down the mathematical mechanics of long $5,000, generating nearly $3,000 annually in automatic income. Breath. At year 20, your total personal cash contributions equal $120,000, but the total portfolio value expands to approximately $310,000. By year 30, the geometric curve turns steep. Your principal inputs total $180,000, while the compound portfolio value surges past $850,000. At this juncture, the annual dividend payout alone generates over $20,000 making. Most individual investors fail not because their asset selection is flawed, but because their psychological system collapses during market volatility. They buy aggressively during euphoric market peaks when valuations are stretched, and they panic negotiable operational overhead cost paid directly to our future balance sheet. Set up an automatic recurring bank transfer that routes a fixed percentage of every paycheck into a dedicated brokerage balance immediately upon receipt. Step 2 is to establish strict selection filters focused exclusively on durable, cash-year record of rising cash dividends. Avoid highly leveraged enterprises, unprofitable high guessing. This eliminates human bias from the accumulation process, ensuring that you systematically buy more asset units when market prices drop and fewer units when valuations stretch high. Over decades, this mechanical execution drives down your average cost basis across your entire portfolio balance. Step 4 is to minimize capital friction caused by management fees, excessive portfolio turnover, and unnecessary tax realization. High advisory fees and active trading churn act as continuous drag coefficients on your portfolio compounding engine. A modest 1% annual financial advisory fee, compounded over a 30 term, you retain maximum economic yield inside your own balance sheet. Pause. Let us address the primary risk factor that destroys even the most logically sound financial blueprints: behavioral fatigue. The modern environment is engineered to shatter your attention span and entice you into short-earned capital. If your strategy feels calm, systematic, and monotonous. You are aligning your capital with the fundamental physics of long friction, financial throughput to building automated asset retention. Your balance sheet transforms. You stop trading your limited time for volatile cash flows and start owning productive systems that generate capital indefinitely.